Welcome to ForexTV.com. It's Thursday, December 6th. I'm Remy Hokie for your New York Forex Market Buzz. In New York afternoon trade as of 12:40 p.m. Eastern Time, spot euro-dollar is at 146.40. Dollar-yen is trading around 111.15, while sterling-dollar is at 202.90. Earlier this morning, the Bank of England cut its key interest rate by 25 basis points to 5.5% from 5.75%. And the ECB left rates on hold as widely expected at 4%. ECB President Trichet said upward inflation risks are a key concern, even as the growth outlook remains uncertain. And briefly in U.S. data, new jobless claims show that the number of workers filing new claims for unemployment benefits fell last week, but the 4-week average hit a 2-year high. Joining me this afternoon is Rhonda Staskow from Thomson Financial. Good afternoon, Rhonda.
Good afternoon, Remy.
Thanks for joining us today. Well, in New York afternoon trade, equities have managed to stay in positive territory, and the market awaits the federal mortgage rescue plan, with President Bush expected to discuss his administration's plan at 1:40 p.m. Eastern. But with the session's key events out of the way, let's start out with rate differentials. How does today's BOE and ECB decision affect the outlook for the majors?
I actually think the rate decisions, particularly that we have seen this week, are so divergent that maybe it could lead to some stability for the U.S. dollar, because on one hand, the central banks are worried about growth and the recent pressure on funding rates, particularly LIBOR rates, which for sterling hit 9-year highs. On the other hand, even those who chose to cut rates this week, which include the Bank of Canada and the Bank of England, are still worried about inflationary effects. Now, those concerns over inflationary effects had the opposite effect from the BOC and Bank of England for the ECB and the Reserve Bank of New Zealand. Those two central banks chose to keep rates tight, and they also chose to announce that they saw rates staying tight for some time. And of course, Trichet said some on the ECB panel wanted to raise rates. To that end, for the dollar, it means you have some currencies bid, like the euro and Kiwi, but on the other hand, the Canada and sterling have been sold this week. So the net effect for the dollar ends up, I think, range trading until the market decides whether 6 months from now the inflation concerns win out over the slower growth concerns.
And Rhonda, indeed, this week has been heavy on the central bank front. As you mentioned, the Bank of Canada rate cut came as a surprise, and we saw the CAD sell off against the dollar as well as the yen. But with non-farm payrolls out tomorrow morning at 8:30 a.m., based on your expectations, how do you see this playing out in terms of price action for euro-dollar and dollar-yen?
Well, this is going to be very interesting. Remember that to some extent, for jobs data, some people see jobs data as a more historical of data of any other sort of release that's out there, because it really lags the market. But of course, we have a good deal of uncertainty. Median expectations at the beginning of the week were for a 65 to 75K rise, and some forecasters were even looking for a decline this month. But after the strong ADP numbers, forecasts have raised to a median of 100K, looking for a better number. That being said, there's still a lot of pessimistic views out there in the market, with bond analysts noting, as you mentioned earlier, the 4-week average of initial claims being at the highest since October 2005. The fact that the ISM number showed the lowest employment component since September 2003 this week. Challenger layoffs increased. The Hudson Index was down, and the Monster Index also showed the biggest percentage drop since December 2006. So what it tells us that the expectations are really quite wide for tomorrow's number, and it's really could be anybody's game with what happens. So if we do get a bad number, we're going to see renewed dollar selling, particularly after the euro performance today. But if we get a number that is towards the 100K that the market is now expecting, I think it will be good for the dollar, particularly because we've seen the dollar index improve this week. Given that, I'll give you what my forecasts are, and this goes back to the earlier view that the mixed central bank response to the current market situation will probably lead to a steadier dollar because of this debate between inflation and slowing growth. So, for instance, on the euro, I think the highs will be capped at 148. and we could see risk for a move to 144, particularly if we get a good data. For sterling, I see a range of 2 to 205 going forward. And for Aussie, 8650 is key support now, and a break of that sees 8450. Since if the slow growth scenario pans out, if we get a weak jobs data, that's actually bad for global growth and actually will hurt the high yield currencies like Aussie and Kiwi, and risk coming under pressure because of carry trade plays. For Euro Yen, I have some interesting observations. Out of Tokyo, there's the view that the recent meeting with the Europeans and China resulted in an agreement to let the euro fall against the Chinese yuan. So they believe that you're going to see euro yen continue under pressure. So if the euro yen gains we saw today start to reverse and go lower on back of continued euro yuan falls, we could see the euro yen cross drop to 160 in the next few weeks, based on this supposed agreement with China not to buy the euro as aggressively. And finally, for Aussie yen, though better bid today, I see the top side of the range for Aussie yen at 98, but see risk for 93 because I do believe global growth will continue to slow.
Okay, Rhonda, last but not least, now that we've covered the majors and the crosses, the market awaits the FOMC decision on rates on December 11th. And although much weight has been placed on tomorrow's NFP data, if you could give us your outlook for the Fed.
Well, I do think if you look at a couple of weeks ago, they didn't seem inclined to cut rates anymore, figuring they'd done enough. But of course, credit market conditions have deteriorated, and I think that's a key factor that will be behind their decision. And so, assuming that we get a reasonable jobs data, I think we will see the Fed cut rates by 25 basis points. I don't think that they were enamored of a view of cutting 50 basis points as the market tried to price in, particularly if they weren't keen to cut rates only a few weeks ago. But because we've seen very bearish statements from Fed's Yellen and also from Rosengren just this week, I think they will continue to ease and then be 25 basis points.
Okay, Rhonda, thank you very much for your insight and analysis today. That wraps it up for your Forex Market Buzz with Rhonda Staskow from Thomson Financial. I'm Remy Hokie. Join us later this afternoon for PM Exchange right here on ForexTV.com.